Earlier this week, we reported real unemployment is up in June to 10.3%. Inflation expectations spiked this week to 5.9%. Consumer confidence, while up this week to 74.9, is still in recessionary territory, and business confidence for June is down 1.5 points to only 88.8. On those numbers, we said the Reserve Bank must think deeply before inflicting more interest rate increases on Australia. Wednesday's announcement by the ABS that CPI for May was 5.6% was good news. Today, we bring the full power of Roy Morgan's deep data, research into the lives of over 65,000 Australian households, and show even more reason why the Reserve Bank and of course the government must be very, very careful. Welcome to the Financial Year 24 webinar. Looking forward to a year filled with uncertainty and foreboding. I don't think we've felt so much apprehension since COVID hit us for six. Only this time it's worse because we can see it coming. That's the economic cliff, of course. Back in March 2020, it just crushed us, but this time it feels like death by 1,000 cuts. That said, maybe it's not all bad news. For example, we're getting wealthier. In fact, we're marginally wealthier now than we were at the start of the pandemic. And a very interesting fact, half the population accounts for more than 95% of the nation's net wealth, and the other half accounts for less than 5%. That's what I call a wealth divide. And at the extreme, the bottom 10% have net debt, and it's getting worse. So what does it all mean? Well, I'm going to take a deep dive into the data and ask an expert for his prognostications. Shortly, I'll welcome a man we see just about every night on the ABC News, Alan Kohler. Alan has a very interesting take on the upcoming financial year. But before we talk with Alan, let's look at those wealth and debt numbers I mentioned in a bit more detail. Today, we're launching the Roy Morgan Wealth Report that investigates Australians' wealth over 1.5 decades, specifically since 2007. This is the 6th edition of the Wealth Report, and it focuses on the 3 years between March 2020 and March 2023. I'd like to thank Suella Kamal and Patrick Gates and Karen Levine in the financial services practice here at Roy Morgan for authoring this outstanding report. And in case anyone's wondering why wealth, well, wealth matters. It matters to individuals, to communities, and to nations. Who has wealth matters, and what form it takes matters. Whether wealth is growing or shrinking matters, and how it's being transferred matters. In 1776, Scottish economist and philosopher Adam Smith said, "Wealth is power." This power, he said, takes many forms, but at the most basic level, wealth is both a buffer and a launch pad. It protects against the slings and arrows of outrageous fortune, allowing unforeseen crises to be handled while maintaining an existing trajectory, and it offers a platform from which to pursue opportunity and to maximise potential. So to the Roy Morgan Wealth Report. The first thing that struck me is that there's good and bad news everywhere we look. The first bit of good news is that the value of total personal assets, excluding debt, that's the blue line at the top, grew to $12.4 trillion in March 2023. That's a 22.2% lift since March 2020. The bad news is that we're now suffering high inflation. And once we allow for the CPI, the red line, the value of asset increases by half. So just 10.9% in the 3 years. And that doesn't even factor in debt. But before we look at debt, where does this per capita wealth actually come from? Well, the answer's quite simple. It comes from the roof over our heads. The dominant source of wealth in Australia is owner-occupied houses. That's the blue line across the top. And the vertical dotted line is March 2020, when COVID hit. But of course, it's more than just COVID. It's also when interest rates on home loans were at historic lows, and when the Reserve Bank Governor, Philip Lowe, rather injudiciously it turns out, declared that those almost non-existent interest rates would stay that way for at least another 4 years. He was wrong. The value of owner-occupied homes represented the largest absolute increase in the 3 years under our microscope, up $2.3 trillion, or 45.7%. And this was largely driven by soaring house prices and new home buyers entering the market. A distant second in terms of growth was savings. That's the green line at the bottom. The value of deposit and transaction accounts went up 14.1% to $810 billion. Coincidentally, a decline in the share market from September 2021 and low interest rates until mid-2022 paralleled a decline in the value of both superannuation, down 1.3% to $2.8 trillion, that's the grey line in the middle, and managed funds that came down 21.2% to $130 billion. But now what about debt? And the bad news that Australians' personal debt grew a whopping 53% in the 3 years between March 2020 and 23, up from $1.25 trillion to $1.9 trillion in debt. While, as we saw before, personal assets grew by only half that, remember, up 22.2%, the good news is that despite the value of personal assets growing more slowly than debt, the substantially greater value of personal assets compared to debt ensured that net wealth still rose 17.8% over the 3 years, from $8.89 trillion to $10.47 trillion. We need to ask ourselves, is all that home mortgage debt good debt or bad debt? Economists talk a lot about good debt and bad debt. In a nutshell, bad debt doesn't increase your wealth, but good debt does. Examples of bad debt would include things like credit card debt, car loans, and payday loans. And good debt would include HECS debt, business loans, and of course, home mortgages. And over the 3 years under review, fueled by low interest rates and Philip Lowe's unwise prediction, owner-occupied home mortgages went through the roof. Just look at that blue line. That's a lot of good debt. But sadly, not all good debt is manageable debt. And since then, 13 interest rate increases and accelerating cost of living pressures have pushed many Australians into mortgage stress. More than 1 in 4 mortgage holders, an estimated 1.43 million, are suffering mortgage stress. They're struggling to manage their monthly mortgage payments and are at risk of losing the roof over their heads. And if the Reserve Bank increases interest rates to 4.35% next Tuesday, mortgage stress will jump to 30% of all mortgage holders. They'll have gone from good and manageable debt to crippling debt in just 1 year. This is a dangerous place for the economy. Owner-occupied housing debt increased by 57.4% over the 3 years to $1.4 trillion. Interestingly, the level of debt on investment properties, that's the red line in the middle, also rose, up 40.7%, but nowhere near the level of owner-occupied mortgage debt. So to bring all that together, net wealth grew from $8.89 trillion to $10.47 trillion, a rise of 17.8%, driven by the increasing value of owner-occupied homes. After allowing for rising inflation, though, since mid-2021, the current level of personal wealth in real terms is only 7% higher than it was in March 2020. So we're going in the right direction, but only just. And the last part of that red line is showing negative signs. So are the rich getting richer and the poor getting poorer? Well, interestingly, the strong gains in personal net wealth have reduced the percentage of wealth held by the richest 10% of the population, down 5.5 percentage points. So the rich or the very rich are not getting richer. One factor behind this is that housing is a form of wealth that's broadly distributed across Australia compared to other less well-performing asset classes like shares, which are likely to be held more by wealthier segments of the population. Consequently, the wealthiest 10% of Australians currently account for 42.1% of the nation's net wealth. By contrast, the next four wealth deciles, deciles 6 to 9, their share of net wealth increased from 48.9% to 53.3%. This is where the housing boom and the real wealth resides, and it means that 50% of Australians account for more than 95% of the nation's wealth. At the other end of the spectrum, the bottom 5 deciles, which account for the other 50% or half of the population, made smaller gains and now have 4.6%, just under 5% of the net wealth. So while the average net wealth held by each person in the top decile is now just over $2 million, it's only grown by 2% since March 2020, substantially less than that experienced by all the other deciles, except that is for the poorest group, decile 1, which slipped further backwards into further net debt. Nevertheless, the average net wealth held by each person across Australia is highly uneven. The average amount of net wealth held by each person in the top decile is 10 times more than Australians in decile 5. But what we saw is that the real growth is in the middle deciles. So what about renters and those who've already paid off their home? Well, the growth, as we've seen before, in net wealth is highest among those paying off their homes. That's up 37.7%, followed by those who own their home outright. Their net wealth went up just 6.5%, and renters saw a drop of 16.5% in net wealth. Leaving growth aside, the upper wealth deciles are dominated by those who've paid off or are currently paid off their home loan. In March 2023, 66% of those in the highest wealth decile had already paid off their home, while 33% were in the process of doing so. Only 1% were renters. By contrast, the lower wealth deciles tend to be dominated by renters. So now, what about that old chestnut? Are older Australians squirreling away the wealth of the nation? Well, it looks like they are. Average net wealth increases with age up to age 64, before levelling out at about 65 and over, when people begin moving to semi-retirement or retirement, drawing down on savings and superannuation. That said, net wealth has grown significantly more among those aged 18 to 24 or 25 to 34 since March 2020. A key factor behind this, of course, is the increase in the number of young people, those aged 18 to 24 and 25 to 34, in the property market, driven by the post-2020 housing boom that attracted new buyers to that housing market. Now let's look at whether Australians as a nation are more trusting or more distrusting. First, little background. Roy Morgan constantly tracks trust and distrust using a continuous survey. We've just entered our 6th year of asking about 2,000 Australians each and every month which brands they trust and which they distrust. And we also ask them why. And we record exactly what they say in their own words. The research is open-ended and unprompted, and we look at themes using AI. So what have we found that will inform our view about the year ahead? The first finding is that COVID introduced Australians to a new kind of distrust. We distrusted state governments for locking us down. We distrusted the federal government for botching the vaccine program. And as COVID rolled on and the $90 billion JobKeeper scheme rolled out, Australians watched as major corporations received hundreds of millions of dollars that they didn't need or deserve. That created a whole new kind of national distrust. The graph here shows the major cause of national distrust after the start of COVID was greed and being too motivated by profit. For example, Qantas received more than $856 million in JobKeeper payments, plus an estimated $1 billion in government subsidies, but paid nothing back to the government despite delivering a $1 billion profit in the first half of the financial year 2022 alone. Harvey Norman repaid just $6 of the $22 million it claimed in JobKeeper payments, despite posting a record profit of more than $1 billion for the year ending the 30th of June 2021. The red columns here reveal the impact of greed and profit obsession on distrust. And when we put this in the overall context, we see that just one cause of distrust, greed and being motivated by profit, accounts for most of the distrust we're seeing as a nation. The black dotted line is net distrust, calculated by subtracting distrust scores from trust scores, trusts in green. It's perfectly clear that we've become far more distrusting over the past 3 years as a nation. But now it's my pleasure to welcome Alan Kohler, one of Australia's leading finance and business journalists and commentators. Hi, Alan.
Hi, Michelle.
Can we get started with a really big picture question? I'd like to ask you about technology. So technology's driven the post-industrial revolution, but what happens next?
Well, obviously what happens next is artificial intelligence, which is here now. I'm using it all the time, to be honest.
It's almost what's happening now, isn't it?
Well, it is happening now, and it's really interesting, but it's challenging in two ways. Firstly, the question is to what extent it's going to replace human endeavour, human work, and nobody really knows that yet. But it does look like it's going to replace at least a lot of routine cognitive jobs in the way that robots replaced routine manual jobs.
So that's going to change things enormously. Do you have any view of the economics of this?
Well, the economics of it have a lot to do with work and how that's going to change. I do think that it could lead to greater productivity. We've had a problem with declining productivity for some time now.
Yes.
It's possible that artificial intelligence improves productivity if it is allowed to work with human beings and improves the way that human beings operate.
The point you make about work is really important. It really will change the shape of work, won't it?
To finish on that, that AI is currently being developed by companies planning to sell it to companies to use it to reduce their costs. It's going to be all about cost reduction.
Great. So let's get back to the economy. The Reserve Bank of Australia has a habit of making dramatically wrong interest rate decisions. Do you see interest rates levelling or even falling in the next 12 months? What do you think?
I really hope interest rates do not fall, because if they do, that'll be because there's been a recession, or there is a recession.
Right.
And the economy has slowed more than the Reserve Bank wanted it to, so then it has to reverse course and cut interest rates in order to to preserve jobs and to boost the economy. So what I'm hoping is that that there are no more interest rate increases, which I think is not required anymore. I know that the market and most economists are predicting at least one more rate hike, possibly two. I don't myself think that that's necessary. I think the 4.1% is fine, and they should just wait now to see what happens. And my preferred scenario is that we end up with 4.1% cash rate for another 2 years.
Great.
Because the economy is stable, everything's fine, and the Reserve Bank doesn't have to do either any more hikes or any cuts. That'd be great.
So thinking of that also, you heard me say earlier that owner-occupied housing has driven the growth in the nation's wealth. And we're constantly hearing that there won't be enough houses to accommodate Australians if we have this immigration coming in. Is that your view?
There is enough housing being built to accommodate immigration as we're currently seeing it. If you look at housing starts and housing approvals, there's definitely enough. You know, that is to say, as long as you, I mean, as long as you accept that there's, you know, 2 or 2.4, something like that, people per house.
Right.
You know, you don't need one house per immigrant. We're going to have 400,000
Yes.
immigrants this year, possibly 450, somewhere between 400 and 450. You don't need one house
for each of them.
For each of them.
Yeah.
If you did, we'd be in trouble. But if it's, you know, 2, then we're basically fine, right?
So you don't see a housing scarcity as a major issue?
No, I don't. And nor do I see a housing glut coming about later this year as a result of people defaulting on their mortgages.
Yes.
There's a lot of people coming off fixed rate mortgages onto variable rates at a much higher level. So they're going from a 2% fixed rate to a 5 or 6% variable rate, and that's painful. And there've been quite a few predictions that switch of about 800,000 to 1 million people moving from fixed rate to variable rate will lead to a lot of houses coming onto the market. I'm not sure that's correct. I think that it's difficult to see a big housing decline without a big increase in unemployment, because as long as there's jobs around and there's enough jobs for people to work 2 jobs, then that's what people will do in order to keep their house. I mean, when interest rates went to 17.5% in 1989, I got a second job.
Right.
And
I think I extended my mortgage for 100 years.
You do what you have to do.
Yeah, exactly.
You know, I just worked all the time for a couple of years in order to just keep the house. You know, you just do what you have to do.
Yeah, and I think Australians will do that.
I think so too. And so I don't think there's going to be either a shortage due to immigration or a surplus due to what they call the mortgage cliff.
Yes. So finally, do you think that the difficult line that the Reserve Bank's walking by tightening monetary policy to get inflation back to what it's aiming for, 2 to 3%, will push us into recession?
No, I don't.
You don't?
As long as they don't keep going, you know, like if the cash rate ends up at 4.6%, then maybe we get a recession. Then you have to start talking about what is a recession, because the New Zealand's just had a recession of 2 consecutive quarters of negative GDP, but really it was 0.7% decline in one quarter and 0.1% in another quarter, so not much of a recession. And we had a recession in the pandemic, where there was a big decline in GDP in one quarter and then a 0.1% in the next quarter. So it was 2 consecutive quarters. You can call it a recession, but really it was just a big drop in GDP and then a recovery.
Yes.
And so I don't know that anyone really regards that as being a recession.
It wasn't long enough for it to feel like a real recession.
Not really, no. But then again, if you look at it in per capita terms, we're already in a per capita recession. And that is to say, if you divide the gross domestic product by the population, the per capita GDP is declining and has been for a couple of quarters.
I think unemployment's going to be critical.
Yeah, so if unemployment increases to 4.5%, as the Reserve Bank would like to see, then I'd call that a recession. You know, although they want it to happen over 2 years, right? So they want the unemployment rate to be 4.5% in the end of 2024. So that's 18 months. So, you know, an increase in unemployment over 18 months of 1%, is that a recession?
It will feel like a recession for those people who lose their jobs, won't it?
That's right, exactly. But you know, the question is, statistically, do you call that a recession? I don't know.
Yeah.
I do think that the definition of 2 consecutive quarters of GDP going backwards is too simplistic. So I just don't
All
know.
right, Alan, thank you. That was fascinating. Thanks very much.
My pleasure.
Great. And that brings this interesting webinar to an end. We know it will be a challenging year, so why don't you start with the market intelligence in the 2023 Wealth Report? It's now available from the Roy Morgan online store. So from me, Happy New Year, financial year that is. I'll see you next time with more data and insights. In the meantime, why don't you subscribe to our YouTube channel? See you next time.